This is the kind of stuff that is going to separate you guys from the rest of the traders out there. The rest of the traders out there will look at something like this and they will sell like crazy into this because they are favoring confirmation over trade placement. They are dying for confirmation. And this, or overstriving for confirmation, is what kills risk management. Because confirmation, the very nature of it, means that your sellers or your buyers that you need for exit liquidity have already started to pile in. And so what that does, if you think about it, if you're selling it, let's say up here, this was above a minor value at that point, but let's just say this was above this point right here. And you know that all of your your sellers, I should say, are all going to be down below this point. Up above this point, you have buyers. And so from those buyers, you're taking the opposite position. You're selling. That's what's happening. So you're taking that buying liquidity, that breakout buying liquidity, and you're betting on the opposite of that based on the overall trend. And then you're expecting that when we get through this threshold price, the psychological threshold that we're talking about, which again is why this is called ATS, called action threshold software, because this is a threshold in which people will take action. At a expansion line, they will flip from buyers, they'll get stopped out, and then they'll switch to sellers. When you sell to the buyers up here, you are generally, to make this look a little simpler, you're looking at this, above this fair market value is a buy zone, and below this fair market value is a sell zone. We don't know what it's going to look like. We don't know how fast it's going to go, how many candles it's going to take, the little intricacies in the candles. We have no idea. All we know is that this is the dividing point between a buy zone and a sell zone, and it's a psychological threshold. That's all that we know at that point. And we know in order to get a repeatable buying and selling trading strategy, we have to think about it from entry liquidity and exit liquidity. Because the people that move this market, that are making it do this, is not me and you. The people that are making it do this are the banks. And they need exit or entry and exit liquidity. They need it. So the way the market is going to move is going to be in accordance with their liquidity harvesting efforts. They are going to sell in a situation like this because they know they've established neutrality here and that they're going to get the market to counterweight itself to the buy side when you break out. It's a simple nature of seeing a market go sideways and you're like, okay, everyone's looking at this like what's going to happen, and then you see it go like that. This automatically, just by the nature of what that looks like, makes the market get heavily weighted to the buy side. And breakouts don't work long term. So the people that are buying through here, up here, are naturally going to put themselves in a weak position. So we know that it's not about liquidity that we personally need. It's about syncing with the cycle that's needed for the higher time frame players to do what they do. We look at this as a circle. The markets are always operating in a circular fashion of accumulation and distribution, like this. Okay? You have accumulation, and then it goes down into distribution, then it goes back into accumulation, and it goes up into distribution, and it goes around and round and round. So here's that neutral point. As it starts up here, it goes into accumulation. Then as it goes down here, it goes into distribution. Then as it comes down here, and we get another box right here, it's going to go back up into accumulation. Up here, accumulation, and then go back down below the fair market value into distribution. It's constantly like this. That's the cycle that the market does. So you could think about it like that. It's a circular pattern, accumulation, distribution. And you could think about the box is where the circle starts. And it's super important to get your mind into this, because when you start thinking about the market like this, you stop thinking about it from a selfish perspective of it only doing what you want to do, what you want to have happen. The market is a liquidity seeking machine. It has to be. It follows the path of least resistance. Our cheat code is having the start of the cycle and having directional bias. That's our cheat code. Everything else here is just a fancy way to try to enter and exit our institutional levels, liquidity lines, all that. This is it. It's understanding the circular nature of the market and having directional bias and working on your ideas, your expectations, starting with your higher time frame from clues. You look for those clues as catalysts. Those are your catalysts. And then you try to leg in to the circular pattern away from that clue. And you do that by understanding the fair market value on the lower time frames and generally how it should behave around those values if your clue is a winner. You guys are counting on those FOMO buyers coming in based on this breakout, because that is dumb liquidity. That is risky liquidity. It's risky for them to do that. They might get paid, but if you are adapting to the circular nature of the accumulation distribution cycle, we know that the probability is going down. And that way we know that the probability of these guys making money is very low, and that our payday is going to be, our own accumulation is going to be accumulating sells up here from these guys and then distributing buys down with these guys that are doing the same thing, because these guys all now start FOMO selling into this. Why? Because they favor confirmation over trade placement. That's why. And that's how you adapt to the cycle in a repeatable way over and over again. You accumulate and you distribute the same way the banks have to do it. And that's what lines you up for success.